to go back to the other side of the coin about, what you see on social media and how it's pitched as, oh no, this is something that the average person should maybe DIY and try and figure out themselves. And that seems like a recipe for disaster, because one thing that I hear about in terms of IULs is this concept, and we've talked about this a little bit before we started rolling, of borrowing against yourself. And, you get to be your own banker. Ooh, I've played Monopoly. I've been the banker before. I win when when I'm the banker.
Take a little off the top.
Yeah, skim. Yeah, I mean, who knows? My wife didn't talk to me for a week, but it's neither here nor there. But I've also played against somebody when they were the banker. And it can go both ways, and it can be a really unfair game, and it can get out of control really quickly. So I guess, first and foremost, this concept of borrowing against yourself and being your own banker. You hear that, and your first thought is?
I get concerned.
Why?
Yeah, same.
Mainly it's discipline, right? Treating a long-term insurance instrument as a bank is just not exactly smart, and usually it's from a discipline standpoint.
Is it
right?
Because it's meant to be that long-term, that if you purchase an IUL and then all of a sudden 5 years down the road you're looking for a loan on it, that's probably a recipe for disaster, right?
It very well could be, depending on how often you're wanting to take money out.
Yeah.
If you have a policy for, call it 5 years, and maybe you want to go buy a new car, and instead of getting a loan from a bank institution, you want to use an IUL. Can that work? Absolutely, it can work, right? Because you're still essentially earning interest on money that's borrowed. That could be a positive. But if money is going in and out, in and out, in and out, and then you lack discipline in that planning process, that's where I think you get in trouble with IULs, where you could potentially lapse it. You could put yourself in a position where it's upside down. You could put yourself in trouble. So we kind of talked about it before, but it's because of human discipline, I think.
Yeah. When I talk to our life insurance carrier partners, folks that have been around doing IULs for 20, 25 years, millions on the books, been in the insurance game for over 100 years. When I ask what's the biggest risk in an index universal life policy, it's not the product, it's not the cap rates or the participation rates on the index, right? It's not the mortality charges. The biggest variable in danger for an IUL's success is the client, because we see that these IUL products, we see them every day. They work if properly structured and properly managed. It's like any instrument out there, right? And I think that's what Drew's talking about with discipline. Like, a lot of clients, life doesn't happen the way we think it's going to sometimes.
Yeah.
And that's where we can get in trouble with the be your own banker idea.
You just kind of touched on a phrase that I saw in my YouTube research.
Yeah.
Was this notion of, for an IUL to be effective and successful, it has to be structured correctly and funded properly.
Mm-hmm.
Can we shine a little light on what exactly that means? Because it rolls and it sounds great, but what does that mean to the average person?
So usually when we're talking properly structured, if we're talking about a long-term funding strategy that's more than 5 years, we're talking about a minimum, what's called a non-MEC face amount. All that really means is we're keeping the cost of insurance, mortality charges as low as possible, while still allowing a client to access the money via loan tax-free down the road, right? So the entire point is to keep that cost as low as we can, so that cash value inside the plan, earning interest, can continue to grow at the most effective way. That's number one. If we're funding for more than 5 years, we're going to want to use what's called an increasing face amount, right? Mm-hmm. Face amount option, where it's going to start out at the lowest possible place it can, and then it's going to grow over time as cash value inside the policy increases. So by doing it that way, right, at least during the funding process, especially if we're funding more than 5 years, that is how we ensure that an IUL is properly structured. But we have to make sure we're contributing that premium, every year, right? That is a set expense now. And we're going to pay that every year for X amount of years, however many years we agreed to pay.
Well, that's got to be one of the questions that the advisor has to ask the client is, are you aware that this becomes part of your expenses? This is baked into the bread, as we like to say, in terms of what your retirement strategy is going to look and feel like.
It should be.
Yeah.
And I think that's the issue we see oftentimes where a policy maybe doesn't look as good as it was advertised. It's because someone was supposed to pay, let's say, 10 grand a year into it, and all of a sudden, year 2, year 3, they've already pulled it back to maybe 5 grand a year.
Mm-hmm.
Right? There's effects to that on the policy long term. I mean, that would be with any financial instrument.
Yeah.
So yeah, it has to be looked at as now a set expense that they're going to pay every single year. And again, long term, right? This isn't a short term investment. That's not what this product is. It is a long term insurance product. And if you don't structure it properly, you don't fund it properly, then yeah, I mean, there could be issues down the road. And I think that's what, when you do research, you're naturally going to see the horror stories first.
Oh yeah. Oh
Right?
yeah.
Yeah,
Those
absolutely.
bad Google
You know,
reviews.
I mean, that's how it always works.
Mhm.
But typically when there's an issue, it's because there was disruption somewhere along the line in terms of how we were funding it, how the death benefit was created. Maybe someone took money out early and they didn't pay it back. So there's a variety of issues that you can come across, but structure and discipline has to be done appropriately, or maybe it wasn't the right call.
And that's part of the issue that I have with this like online discourse about insurance, like IUL, right?
Mhm.
I think a lot of times folks are looking for something different than the traditional stuff.
Well, they're also looking for a cheat code. They're looking for the
Right.
easy way. They
And
get, I
that's-
mean,
Yeah, and the IUL kind of gets put in that kind of cheat code section with like crypto. You know, I've had advisors come up to me and be like, "Hey, yeah, I got this crypto guy. He's wondering if you should put money into an IUL or put it into Bitcoin." I'm like, "Dude, what is going on? Like,
what did
like,
you just
this
say?
is
I know, my
not. This
bingo
is
card.
they're leagues apart." And I think one of the things that gets lost in this TikTok, Instagram, and there's we talked a little bit about it before we started rolling. It's like there's so much to cover in the IUL conversation that a 30-second reel can cover. But one of the things we lose is like an IUL is just like any financial instrument out there. It is meant to be a part of a broader financial planning strategy. It's not the end all be all.
It is not.
And that's where I think a lot of folks get into trouble as an advisor is recommending, "Oh no, this is now your 401k. This is your 401k now," to somebody that's making 50, 60 grand a year in income. That is not what the best use of an IUL.